Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good day, all. Ira Epstein of Linn Associates with your financial market wrap-up, and here we are on Vets Day. Happy Vets Day, everybody, and thanks for your help. And it is Monday, November 12th, 2018, just after 4:30 p.m. Central Daylight Time. The stock market took it on the chin. It doesn't like Apple's new phone. It doesn't like the results of what's going on. The market's looking hard. I'm reading all the news stories about how its suppliers, the amount of lines they had put up for this new phone, and now they're being told to cut back on them. They never hit the 100% utilization. So who knows? FANG stocks, you know what they do. Then we're looking at the dollar just rip apart. Look at all these currencies at the mercy of this strong dollar. And now there's the word, what about global growth? What about China and the U.S.? There's a whole mess going on. In the energy market, we heard over the weekend that the Saudis want to cut back production by as much as 1 million barrels a day between them and other OPEC members. Didn't seem to have a big impact on the market today. Gasoline did better than anything, and so did nat gas. Although nat gas is up so much, you got to wonder, is it getting ahead of itself at this time of the year? When we look at a weekly area chart of closes, we're still fairly far away from where we were in October when the market came back and challenged the close of the end of the year. When we take a look at Fibonacci numbers, this was the low, by the way. That's the high that I'm using. I circled them for you. You made your 2/3 retracement, so to speak. You have fallen back down. Remember, these boxes on the way up offer resistance levels. So we know what we've got. The market's played with it. The next time through these highs, I'm assuming there'll be a next time, that sets this all as a low. Until that occurs, what do you have? You got resistance areas in here that are pretty formidable right now. Now, the interesting part is the market has still got a pattern of higher lows and higher highs. Will it be able to take out 27.1275 to negate that pattern is a big question. If we look at the 18-day average of closes, I'm going to come back to yesterday. You can see how the market stopped at the 200-day, and then the question was, if it's going to follow through, where's the possible next support? I'd be arguing the 18-day average of closes, which is where you're at right now. So because you closed under that number, you're going to say that for the moment, the bias is down. The swing line trend of higher highs, higher lows is alive unless you take out 27.1275. Now, as a market technician, let's assume you take that number out. You'd still have a higher high then and a lower low. Not a true trend, as I like to call it. If you took that out, the 27.12, the next resistance level, 26.38. If you bounce from here, the 200-day average is your resistance point at 27.70. Now, when we take a look in the S&P at the close on December 29th again of last year, look where you're at. That's well above the Bollinger Band. It's nothing in here, so it's just in that 2700, just under its zone. That could be where the market's headed again. When we come to the NASDAQ, you can see the market is still above where it finished out 2017. The last break low that we had here was 68.65. Today you took that out. You got to 68.25. So you've broken that rally trend. Now you've got a lower low, higher high. You have two levels of resistance now facing you. You've got roughly the 7,000 level, which is the 18-day average of closes, and 71.20 being the 200-day average. We had a nice bounce, but now what? That becomes the big question. In the Dow, this is where the market in this light line finished for 2017. The pattern is still the strongest of the stock indices right here. Higher lows, higher highs, still over that 18-day average. If I take you back to Friday, the market was way up here, nowhere near any of the other numbers. It fell back Today, through the 100-day average, couldn't quite pick up the momentum to get to the 18-day. Now, if you take out in this market 25,131, you break the pattern of higher highs, higher lows. I don't know that it's important anyways. You're overbought. And if we come back here and we look at this, you saw the overbought condition of the market, and now the market's paying for that. Still, one of the weakest of the indices has to be the Russell. It's lower for the year again. It took out the previous low. The market's not getting the oomph it needs. Is it going to go back to these lows? Well, that's going to be the big question. I think traders will get beyond nervous. I'm very nervous for them if the market gets under the lows that we saw in October. If this is a pullback and it's a successful pullback and not taking that out, you'll see the bulls come out of the woodwork and say, okay, that was the confirmation, blah, 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 as technicians. I don't know where we're at right now, and that's sometimes not a bad place to be, not knowing where you're at. I just look at the market now and say, listen, the VIX is still in a downtrend. It's correcting an oversold condition. It wasn't able to get low enough to get to the Bollinger Band or 100-day average, and it's respecting, for the moment at least, that area of the 18-day average of closes as resistance. In the T-bond market, you're getting a flight to safety. When people get nervous, they take off the risk. And what are they buying? They're buying bonds. It's not a bad deal at 3.2%, and you say, hey, the stock market's not up for the year, depending on the index you're following, so you've got to be a bit cautious. You've got the pattern, though, here, trying to make the higher high, lower lows. Will the market be able to get to the upper Bollinger Band? Before I even say it, that would be the resistance point that I'm looking for. Support temporarily is the 18-day average of closes. When I come to the 10-year note, lower low, higher high, corrected an oversold condition. You're still in it, by the way. Any reading under 30 is oversold. So I don't see a buy signal. I don't see a sell signal the way that I do charting. In TLT, the market threw out a buy signal today because you have the pattern of higher lows. You closed over the 18-day average, and you can see the momentum's up. The risk, if you took out 112.41, you'd break that pattern. If you can keep it going, where's the resistance? Well, one of those zones is right here, the 115.32 level. But why would we get up there? Remember, this is an inversion market, and we're hearing a Fed that wants to, in December, remember, this is November 12th, wants to raise interest rates. I don't know. You know, you're just going to scare a lot of people with all the cross currents going on. In the dollar index, again, we closed over the upper Bollinger Band. Now, this is where we were on Friday. Today, you got all that bid. You're as overbought as can be. Doesn't mean you can't turn to an embedded reading, but you're getting near what we call some long-term counts in this market. If you use price counts, which we do in our firm, you got some objectives right up here. That does not mean it has to stop going up. It means you're in that zone, as we call it. And look at the eurocurrency. I mean, this market's just coming unglued. Who'd have thought this market's maybe going to challenge the 112 area? Tomorrow's an important day for this. You've got the Italian budget coming up tomorrow. They keep playing games, Italy does, with their numbers, but they want to end up somewhere between 2.4 and 2.6% of their GDP increase here, and it's big. It's against the EU rules. What happens? Are they going to lower their growth? Are they going to talk about it in a different way? And what about Brexit? Still no deal on Brexit. The EU has been getting tougher, not easier. They have all the marbles, and they can afford to do that. This market's weighing on that. Look at the pound. Trying to catch this roller coaster, I wish you the best. I mean, these are vertical moves down, vertical moves up. I will tell you what I wrote my clients back over here. I said, I think it's time that we wait on even looking for trades in this, because every night you wake up, well, every morning you wake up, you don't know with the time difference what the heck's going on. It's like going through a major report every day with this. Very difficult trade. In the end, the market did not get a bid today, which was surprising to me when we saw the stock market down as much as it was. You still have the embedded reading. I think that the market, until it loses that on the rallies, will end up with sells. In other words, the pros will sell into that. If they get nervous, remember, what currency do you buy if you think the world's getting unglued? The yen has been one of those. In Bitcoin, we're stuck at what I call that central line, the 18-day average of closes. It's where I call a market neutral. It's the line in the sand. The pattern is bullish. You've got higher lows, higher highs. It's fighting momentum that is pointing down in the slow stochastics, and the bias is not up because you're settled today under that 18-day average of closes. In the Brent versus WTI crude, I thought Brent would do better today when the Saudis are talking the way they are. It did gain a little on WTI, and as you can see, the trend is still down. I mean, pretty ugly. The embedded readings fully at play, and the pros are selling the rallies on that as long as it stays embedded. When this turns and the red numbers get over the 20, we'll probably be on a rally mode. In fact, you will be on a mode. The question is where to. The resistance all the way up here in WTI, I would be looking at today's highs in both these markets. In the, let me come back here, I did that wrong. In the Brent, you have an outside day down. In the WTI, let me get over to this, you have an outside day down. If you take out the highs of an outside day down, I call that a bear trap if it's done. The next session or the session after that, within 2 sessions. We'll see if that happens, and if so, it would put into play in both of these the 18-day average of closes. And let me give you the caveat. No, I don't walk on water. I don't know that it'll happen, but I know as a bear, I'd be very concerned if you took out those highs. The gasoline market just had a bounce today, but it still has the bearish embedded slow stochastic. Until that red line's over 20, I see the bears in control. Nat gas strong out again as the cold weather, and I mean it's cold. If you're in Chicago, it's been in the 20s here. I mean, we got winter all of a sudden, which is unusual at this time of the year like this. And the market's 2 days in a row up and over that. Keep your eye on this red line. If it closes under 80, it's a sign that the market is peaking out over that this area here, and it wants to back off. Whether it turns into a downtrend, I can't answer. I'll be writing about this and other things. You probably want to see it this week because there's so much to deal with. Right now I'm focusing on Italy and Brexit. I'll be turning my attention to metal markets and energies very quickly. So if you'd like to get a copy of our research, just give my staff a call. Go to our website, sign up for the free issues, or you can click up here. I'm Ira Epstein. You have a good day, and I'll see you tomorrow.